Hi there. Are you dreaming of buying your very first home in South Africa? Here is what you need to know. There are mainly two ways to buy property. The first way is cash. Cash is king. If the seller sets the price at 1.5 million and you have the cash sitting in your bank account, all you get to do is to pay. And of course, you pay the transfer fees, and the property transfer can go ahead easily. But if you don't have that 1.5 million upfront, like most of us, you will need to borrow from the bank. That's called a bond. How much you pay back each month depends a lot on something called interest rate. Today, let's unravel the impact of interest rate on acquiring your dream home. So who decides the interest rates? You might be asking. Okay, the process flows like this. The Reserve Bank, the SARB, print money, then lend it to the local banks at a fee. That fee is called Repo rate. The local bank lends you the money at a fee called prime lending rate, which is basically the Repo rate plus the bank interest. The money given to you is what is called a bond. You basically repay this on a monthly basis for usually a period of 20 years. So what this means is, when the Reserve Bank increases the repo rate, the bank also charges more, which becomes more expensive for you to borrow. On the flip side, when the interest rate is low, the bank also charges a lower rate, and you will then pay a lower monthly repayment. What this translates to our house purchase process is that when the interest rate is low, you get to afford a bigger house. But when the interest rate is high, you get to afford a smaller house. Currently, the repo rate is at 8%, and the bank adds a little extra, which is now a prime lending rate, which is currently sitting at 10.54%. With that being said, since the cost of borrowing is determined by the Reserve Bank, and you and I have no control over that. So as a new buyer, I want you to be smart about this. Yes, there are smart things you can do. Number one, be a step ahead of the interest rate increase. You can do this by always planning your budget, by setting a safety buffer. I can call it a safety buffer for rate increases, because they can happen. In as much as a decrease can happen, an increase can also happen. My second free advice is that if the repo rate decreases, continue to pay the same monthly bond that you've been paying. Just ignore the interest rate. Assume there was no decrease in the interest rate. Just continue paying, because you will then finish paying back the bond a little earlier than the 20 years set. Then number three, your personal bond rate depends on your credit score, your income stability, as well as your deposit size. So it's not like one size fits all, right? A good credit record and a healthy deposit can help you to get a lower interest rate. So here is what I want you to remember. Always check the current prime lending rate before you buy that dream home. Make sure you can afford your bond, even if the rate rises in the future or decreases in the future. But mainly it's the increase that matters. And if possible, pay extra when you can. It shortens your loan repayment and save you thousands in interest. Buying your first home is exciting, I know, and understanding interest rates help you to buy smart. If you find this video helpful, don't forget to like, to share, and to subscribe for more tips of buying a property, mainly in South Africa. I look forward to your engagement. I will see you on the next one. Bye for now.